The only thing I've really learned as I get older is you shouldn't complain about getting old. There's always someone else out there who's got a few more years on you. To quote the great Bob Hope, you know you're actually getting old when the candles cost more than the cake. And fortunately, I'm not quite there yet. But retirement planning and longevity planning are inextricably linked. There's no way to get around one without addressing the other. And these days, retirement might last a lot longer than you think. Today's video is all about longevity risk. And while longevity risk is one of a myriad of different risks that we need to manage or mitigate as we approach and live in retirement, there's no question that it is the biggest of all the risks because it is the only risk that is a risk multiplier. What do I mean by that? Well, the longer you live, the more likely it is you live through prolonged market and economic downturns. The more likely it is that inflation takes its toll on your purchasing power and the cost of the things that you have to buy and that you want to buy. The more likely it is that you can't predict where tax policy and benefits policy and social entitlements go. And certainly we all know that the longer we live, the more we're going to spend on healthcare and the more likely it is we end up needing long-term care. So you have to mitigate and address longevity risk in a plan because all of the other risks that could potentially disrupt a retirement plan just get bigger the longer we live. So in today's video, we're going to walk you through a handful of statistics related to longevity to help you have a better understanding of just how big the longevity equation is for most clients. Hi, I'm Matt Gozdecki, President of Annuity Sales with BackNine Insurance and Financial Services, and welcome to our session on longevity. The place to start when understanding longevity risk as it pertains to retirement planning is to make sure that you're working off of the right data set. And let's face it, this is an area where we can have a lot of bias because of personal experience. I'm sure we all know the person who thinks retirement's only going to last 5 years because the men in their family drop dead at 70, right? But more importantly, it's because there's a lot of noise in the conversation about longevity. And in this fast, immediate news media cycle that we live in, where we're getting bombarded with headlines and stories that look like this or like this, questioning longevity in the United States, it's important to realize that some of these statistics just really aren't relevant to a retirement plan. And that's because longevity is a midpoint for all Americans. We have plenty of people who unfortunately pass away much younger than expected. And if you've made it to retirement, you've cleared a lot of the hurdles that tend to bring down overall life expectancy. So you need to be looking at longevity risk from a perspective of the 65-year-old American. Obviously, that's kind of the age that we sort of expect retirement to occur at. And life expectancy at age 65 is up nearly 40% over the last 2 generations. In 1960, life expectancy at 65 for a male was 12.8 years. And in 2024, that's all the way up to 18.2 years. That is a tremendous increase. Adding another 6 years to the life of a plan, or 5 years for women, well, that's a heck of a lot more spending, consumption, and healthcare that we've got to pay for out of pocket. But it's also important to realize that in most cases, you're not putting together a retirement income plan for one person. You're putting a retirement income plan together for 2 people, specifically a married couple. And whenever you're planning for 2 lives, retirement and the window for retirement starts to look a heck of a lot longer. If you take a look at this stat here, it shows you that there's about, call it a 12% chance for women and a 6% chance for men that the total population will make it to age 95. However, as soon as you marry the 2 together, the likelihood of at least one person in the household living for 30 plus years in retirement jumps all the way up to 17%. And if you add in good health, the numbers get much more significant. I'd like all of you to think about this in a slightly different lens. Imagine that over the course of an entire month, you have 100 conversations with 100 retirement age married couples, all who've done a good job of taking care of themselves and who aren't smokers. Well, 73% of those couples are going to have to plan for at least a 25-year retirement horizon. you got about a coin flips chance, 46% to be exact, of one person making it at least 30 years. And nearly 15% of your clients, 15% of those married households, well, they're going to have to consider a world where they make it past age 100. So let's think about that a little bit more directly. That longevity plan, what's the impact on their retirement spending plan? Well, using today's return expectations and assuming that your clients are invested in 50% stocks and 50% bonds, look at what happens to safe withdrawal rates as soon as you introduce an extra 5 years to the length of the plan. A 4.2% spending rate is considered to be safe, a high degree of confidence for a 25-year retirement. But that gets cut by 50 basis points, a 0.5%, if we extend that out to 30 years. And we have to drop our withdrawal rate all the way to 3.3% if it's a 35-year retirement we're planning for. Put differently, if your client has $1 million saved up for retirement, that's the difference of $9,000 a year in total expenses on day one in retirement. That's a huge chunk of change to explain to your clients, right? And when thinking about longevity risk, it's important to note that this isn't a problem for average Joe American. This is even a problem for ultra high net worth clients. JP Morgan did a study to determine how much is needed for an ultra high net worth couple to fund retirement and their lifestyle for just an additional 10 years. And what they found was the amount of money remaining at age 90 in the average retirement expectation was $5.5 million off of a $25 million portfolio. However, you add just 10 more years of living, and there's only $800,000 in assets left to pass on to the next generation. That's a major chasm. And again, we know that there's going to be a lot more people making it to age 100 these days than ever before. Many of you out there probably know that the number one determinant of life expectancy in retirement is genetic makeup. And I always joke about this with my wife because Gazdecki men, well, unfortunately, we don't have a great track record of sticking around for the long haul. But the women in my wife's family, well, I mean, she's got 5 living relatives who are north of age 95. But putting genetics aside, which candidly we can't really control, the next biggest determinant on life expectancy is how much money you got. Studies haven't been done on this enough. As a matter of fact, the most recent study about the correlation of wealth and health, income and health, was done in the mid-2010s. But what they found was there is nearly a 13-year gap among women and nearly a 15-year gap among men in terms of life expectancy for the bottom 1% of Americans versus the top 1% of Americans in terms of annual income earnings. But that's a big chasm, right? Let's talk a little bit more about the average people. Focus just on that red box on your screen. This is the 20th percentile of income versus the 80th percentile of income. Well, here's the thing. Just that small gap adds about 3 years to life expectancy for women and 5 for men. So your clients who are approaching retirement that have more investable assets, that have been making more income along the way, they better plan to stick around longer than what's average. Because again, life expectancy is a midpoint and there's a lot of variables that go into the range of outcomes. Now, many of you watching this video know that healthcare expenses and planning for healthcare is a major consideration for retirement plans. And the number one crippler of retirement plans is an unforeseen extended long-term care event. And look, we cannot project what the future holds for us from a health and care standpoint, but we can play the numbers to make some baseline assumptions. And one thing you should know is that healthcare spending increases by nearly 50% from age 65 all the way to age 85. That's a major consideration. And overall spending might decline, but your healthcare costs, they're going to go up. And the likelihood of you needing long-term care goes up nearly 5 times from age 65 to age 85. Just so you know, 40% roughly of Americans 85 or older are expected to develop a severe long-term care need. So playing the numbers and examining the percentages tells us that The longer we live, the more likely it is healthcare costs become significant, and the more likely it is we face a plan-altering and lifestyle and inheritance-altering long-term care event. Now, the good news is longevity risk doesn't necessarily need to be a risk at all. As you all know, and if you don't know, you should assume since I did say I'm involved in annuities, guaranteed lifetime income vehicles are a great way to transfer longevity risk from the client's portfolio to an insurance company that's going to guarantee a paycheck showing up in their mailbox or direct deposit in their bank account every single month, kind of like their own personal pension. But what you may not realize is just how much that means to the clients you're working with. Let's face it, when we retire, that should be the promise of great things coming into our life, us doing more of what we've always enjoyed, us learning new hobbies, spending more time with friends, taking that trip that you always wanted to take, and spending time with your grandkids, right? But the fact is, most Americans are underspending relative to their assets. It's estimated that the vast majority of Americans underspend until they're 73 years old. And why? It's because at 73, you're forced to take RMDs. A study published in the most recent JP Morgan Guide to Retirement showed that clients who have a larger percentage of their retirement savings converted into some form of guaranteed lifetime income spend more liberally and freely than others with lower percentages. As a matter of fact, the difference could be as much as 42%. And this is clients retiring with $1 million all the way up to $5 million. I'd imagine those are clients you're trying to work with. And when you think about it, that actually makes a ton of sense. We spend 30, 40, maybe even 50 years of our lives working in some capacity and receiving a paycheck. And then all of a sudden the script gets flipped and we're told, hey, you've got all this money, you are now your own payroll company. And that brings a lot of unease. That brings a lot of concern. But you don't just have to take my word for it. Take the word of two of the foremost retirement experts in the country, Dr. David Blanchett and Dr. Michael Finke. They put out a study earlier this year entitled Retirees Spend Lifetime Income, Not Savings. And in this incredible white paper full of detailed analysis proving the fact that retirement income that's guaranteed for life leads to improved quality of life, their summary of findings states that overall, the analysis suggests that converting savings into lifetime income could increase retirement consumption significantly, especially for married households. Our analysis clearly demonstrates that households spend differently across sources of wealth. Retirees spend a much higher percentage of their lifetime income, about 80%, and spend about half the amount that they could safely spend from other sources. There's no point in putting off for later years what you could be enjoying today. And you can create a permission structure for your clients simply by carving out a portion of their retirement savings and turning it into lifetime income. And by the way, now's a great time to be thinking about it. Annuity rates and benefits are higher than they've been for nearly 20 years. We're in a fantastic interest rate environment, and we're seeing lifetime income guarantees north of 7% as early as age 65, and that includes joint life payouts. Think back to what Dr. Blanchett and Dr. Finke were saying. One of the other questions that they asked in their study was, if you had the choice, Mr. or Mrs. Retiree, would you rather be given $140,000 more in assets or take $10,000 a year guaranteed for the rest of your life as a baseline salary? And guess what 61% of respondents picked? It wasn't the assets. Longevity should not be a dirty word. It shouldn't be something we fear. It should be something we strive for, that we celebrate. We shouldn't be so afraid of running out of money that we'd rather die than end up on our kid's couch. But here's the thing. For so many Americans, that is the reality. That is the thing that they fear the most. That is what creeps into their thoughts. And it's for a simple fact. When you're retired, income's kind of the only outcome that matters. Here at BackNine, we're positioned to support you and your business when it comes to retirement income planning and finding the best product for your client's individual needs. We've just launched an incredible retirement income needs analysis calculator that helps you detail out a client's expected expenses and wants in retirement, and then do a comparison to find out how much of that is currently covered by guaranteed sources and what might be repositioned from other savings to help drive a better outcome and a more secure outcome in retirement. And we are the home of Quote and Apply, and lifetime income annuities are on Quote and Apply. You can shop more than 100 guaranteed lifetime income solutions and find the absolute best product for your client every single time. If they want $20,000 a year and they're 57 today, but they'll be 72 when they retire, all you have to do is plug in the variables, and we're going to show you the product that gives them the most bang for their buck. We make longevity planning easier than any other partner in the IMO BGA space. And these tools are available to you for free. All you got to do is click the link below to sign up today. So when you're thinking about retirement planning, think about ways to hedge against longevity risk and to make sure that your clients' retirement plans never expire before they do. I started today's video with a quote from a comedian, and I'd like to end today's video with a quote from a comedian. In the words of Jim Gaffigan, pie can't compete with cake. You put candles in a cake, it's a birthday cake. But if you put candles in a pie, someone's drunk in the kitchen.